All right. Well, thanks for while our panelists grab a seat. Thanks for keeping up with the heat and the late afternoon. But we're here for a treat. It's pretty exciting because back when Bitcoin is up hundreds of percent, it's often hard to make a case for quant investing, where you're trying to get low volatility, high sharps, and in crypto it always gets pretty dismissed. So before we get started, let's just do a quick round of intros, starting with Sam to my left.
Hi, everybody. First, thanks to the Thai and to Josh for having me here. I feel honored, and I feel honored to be on this panel with such esteemed colleagues. My name is Sam Gaer. I'm the CIO of Monarq's Directional Fund. Monarq, formerly MNNC, most of you might know. Monarq has 3 different strategies in our digital asset firm. We have Bitcoin, Directional, and market neutral. Prior to Monarq, I was at Block Tower for a little while, and prior to that, I ran my own hedge fund, Katana Financial, which was a pretty large volatility, high-frequency trader, as well as crypto and energy. I've held positions in the industry such as CIO at FINRA, as well as EVP CIO at NYMEX, and CEO of NYMEX Europe. So, again, happy to be here. Thank you.
Hi, my name is Anatoly. I'm CEO and co-founder of Nickel Digital. We are a multi-strat, multi-manager hedge fund operating out of London. We run market-neutral, mid to high-frequency strategies, and the whole model is based on diversified group of managers, to be precise, 57 today, based around the world, but trading part of our capital. So we've been in business for 6 years. Prior to that, I was with Goldman and JP Morgan prior to that. Thanks.
It's great to be here. I'm Alfonso. I'm a partner at Silver 8 Capital. We're a hedge fund with a 10-year track record in crypto. Most of the team is based in London, and we have a strategy that has evolved over time. We started as more of a liquid venture fund in 2015, and as we had liquidity and derivatives come to market and also more data, we transitioned to a more quantitative approach to investing. So now we're a long quant fund trying to deliver high upside and lower drawdowns volatility for our investors.
My name's Martin. I'm co-founder and CEO of Cambrian Asset Management. We're a US domiciled, SEC registered hedge fund, and we've been trading crypto since 2018. So this is our 7th year. And the team is basically a former CEO of Winton Capital, former portfolio manager at Millennium, and then ex-Google, Berkeley, sort of San Francisco Bay Area, science and engineering. We're backed by a few folks, including a co-founder of Renaissance Technologies.
Thanks, everyone. So let's get into it. And so let's first take a step back and discuss how quants have evolved in crypto. Let's go back in the days. How was it back then? How is it now? What has changed? Martin.
Well, I can say one of the things that I guess a truism of markets in general is understanding positioning of other investors. And many years ago, with perpetual swaps dominating the liquidity and heavily driven by retail, which used a lot of leverage, it was relatively simple to understand how the rest of the market was positioned. And so if they were really over their skis, it was relatively easy to do risk management to prevent getting caught up in the drawdowns. And there's a more heterogeneity of the way in which leverage manifests itself in crypto. So that's changed. And we'll talk about edge afterwards, but I think anytime you're talking about quant, you have to unitize risk. You have to really understand the sources of risk and then figure out ways in which to manage it appropriately. So that's kind of like most of what we do.
So I've been, as you can probably tell, I've been in the markets for some time. I actually started I actually started as a floor trader when there were trading floors, and I was one of those guys waving their hands. And this is back in the day when trades were executed by saying buy them and sold. And much like if anybody here has played sports, as you go up or as the market started to evolve, what really started to happen was the big differentiator was speed. Markets sped up, TradFi sped up now, low latency, high frequency traditional finance is measured in single-digit nanoseconds, and I even saw there's a picosecond switch that just came out. And so what does this have to do with crypto? I first came to crypto, well, we first started trading in 2017, started making markets while we were trading the VIX. The SIBO came out with their own contract, and then shortly thereafter the CME came out. So being the ARB guy or quant guy that I was, we started arbitraging. And crypto was so misunderstood, and crypto was synonymous with Bitcoin, and that was it in the TradFi world. It was so misunderstood that even with north of $50 million in our main account, our clearing firms would only allow us to arb at five Bitcoin futures at a clip. There was a $1,000 arb between the two.
What year was it?
That was 2017.
Well, so back then you would look at different prices on the exchanges and could manually go on the different exchanges. And
Right. 300 basis points. Yeah.
Right, but in TradFi, that's all we knew. So we had margin up, and you were able to trade between the different venues, and then you could wind out, or let them cash expire. Fast forward, now I get into crypto in like 2021, 22. We start doing a little bit of quant in crypto while straddling TradFi, and the big difference for our software is we have to slow it down dramatically. 100 milliseconds was kind of fast during those days, right? And so predictively what's happened is markets are speeding up. They're becoming more efficient. Edge is harder to find because of that. You can't click. You really can't. If you could show me a click arb right now, that would be great. But you really can't even do that anymore. And so now really speed is being limited in terms of the evolution of crypto and speed and quant really by geographic dispersion, because you can't beat Einstein's theory of relativity. Anybody that can, I have a job for you. But in reality, the spread between the exchanges in terms of time, and in turn, even if they're in the same AWS center, you're still measuring in milliseconds. That's going to change. Anybody here who thinks that's not going to change in the future, you're going to see new exchanges, or you're going to see existing exchanges as you see fee compression, as you see consolidation in the industry. That is going to change, and in order to get volume and have traders trade on your exchanges, you're going to start doing things like lowering fees. You're going to co-locate. Some exchanges already are. And that just begets speed, volume begets volume. And I think you're going to be shocked in 5 years what the volumes and speeds look like compared to today.
So the easy money on those types of ARBs is over.
It's gone. Absolutely.
And what about capacity?
I think when we started this business 6 years ago, many people would do basic ARB in terms of cross-exchange ARB, basis trades, which is still a contributor, but these days, this kind of ARB is being compressed heavily across the board. So you have to naturally expand in the whole other range of quant strategies, including stat ARB, RV, natural HFT market making, and that's where the value still lies. So from the evolution perspective, we're following the path traditional markets have gone a long time ago, and crypto just goes along the same avenue. So the way we approach that logic, you have to diversify across these individual verticals as strategies, but also across individual managers, right? Because you have to chase different sources of alpha, and alpha has the tendency to decay. So you have to basically kind of address this decay by virtue of sourcing alpha from multiple managers around the world.
When you say you have to, I would say that is certainly one way to do it, but I think it's not a have to. I think one of the things that, if I could put myself in an allocator's position, when they're looking at a quant firm, I think it's really, really important not to sort of just generalize and you must get into the specifics of what is the source of return and risk that they're expressing, and how persistent is that likely to be. And if it is ephemeral, then the quant firm is constantly trying to fill a hole. And they may be successful in that, but that is a very difficult endeavor. And you could end up with a lot of style drift. So I'm not sure that like chasing the thing of you're not saying this, Anatoly, but like a manager that is basically like, one thing works now and then it might not work in the future, but we did the exchange arb, now it doesn't work, I'm doing rebate, like market making wash trading, but that might not work, I'll go find something else. I think that's a difficult bet to make by an allocator. I think looking for persistent sources of return is imperative, especially in quant. This is true for style drift concerns for all managers, but especially in quant, because we can often end up trying to make it look like a black box, and that serves no one.
Yeah.
Yeah. Well, I think that Anatoly's approach is a little bit different than most of our approaches. In that Anatoly, you scale your risk and your alpha sourcing on a horizontal basis. You have that luxury. You have that advantage. We as a fund of one, we don't, right? So, look, I got a lot of these, right? Another saying that I heard on one of the first days when I was in the trading floor. I'm sorry for my arms waving because I am a former trader. One of the first things that I heard was traders always find a way to build a better mousetrap. And translating into what was just said here, edge is by definition ephemeral. It is, and it's just the lens with which you view time that determines that ephemerality, right? So, in the context, most edge when you're talking about quantitative methodology, you have a core methodology, a core technology that can be used to search out, find, and extract edge. We have that at Monarq MNNC. It's been in production for about 10 years. AI and ML models are very, very commonplace within the firm, and we're layering that into a directional approach where we think that we can be faster at asset selection or better at monetizing alpha in markets with convexity as well as protecting left tail downside.
I think the way we think about our objective for our investors is to deliver a specific risk-return profile. So an investor comes to us when they want higher upside capture than downside participation. It's that simple. How we do it is a balance between avoiding style drift, because that creates new risks and unknowns, but at the same time, adapting to an evolving market, and adapting range of instruments you can trade, geographies, a market structure. So we have to always think, let's say that a specific kind of strategy has worked well. Is that still applicable in the current regime that we're in now that there's more institutionalization, a different set of venues that people are operating in? It's a completely different market plumbing. I'll give you an example. We started to add options to our trading to manage some of the jumps and tails of the distribution and make sure we had exposure on the upside, reduced exposure on the downside as that market became more liquid and spreads compressed. And that was not something we were doing before 2022, for example. So we're always looking to adapt while making sure that we deliver a specific risk-return profile that investors have signed up for when investing in us.
One thing to also kind of mention when talking about edge is a lot of times the conversation turns to quant is often high frequency, market making, spreads, arbs. It's not necessarily the case, but there are a lot of quant firms that do that, and there's nothing wrong with that. But a lot of times the investor or the allocator is looking at the fund manager, and it's essentially asking this one question, which was asked of us by a guy with a beautiful haircut and a really nice suit at $1 trillion asset alternatives asset manager about 5 years ago, and he basically said to Jay and myself when we were meeting with him, like, how are you going to compete in this market with like 2 Sigma or the Renaissance people, the Medallion Fund? they have hundreds of millions of dollars of annual capex and thousands of people in Two Sigma's case. And our answer was, well, number one, we're not competing for the same spreads as them. And two, we don't have all of that. That's an advantage in this area. But the thing about it is, you can also run a quant strategy that isn't running in a market where the source of return, you're competing with other quants. With quants, you have the ability to have models that are designed to trade rationally, systematically, detect patterns. They have ultimate history and memory. If you set them up to play chess with humans, they will beat humans. If you set your chess engine up to play other chess engines, you may win, you may lose, but the machines are going to beat humans at most games all the time. And so that's I think, edge doesn't necessarily mean that we have to be beating ourselves against each other. We can play in heterogeneous markets where other investors have different time horizons or different risk profiles they want to have, and I feel like that's a healthier place to be.
I'm sorry, we're going on the same topic, but I think it's really important because this is the evolution of quant, if you will, which mimics the evolution of quant in TradFi, where we're now looking through a different lens rather than a strict A to B, bang bang arb. Yeah. We're really looking at larger returns on a per unit basis, right? A little bit more volatility to those returns as our investment lens increases, but importantly, a lot of market neutral strategies are capacity constrained, right? And that's what I mean by at some point you're going to run out of alpha in that particular strategy, and so that's why we're seeing a massive opportunity, and I think the other panelists on the stage think so as well. There's a massive opportunity as the space matures and as institutions come into this space to approach directional investing with a quantitative, we call it systematic, with a discretionary overlay, right? Just to have the human touch to say, hey, if we're going to sell at 100 and it's trading 95, we might want to take our profits, which, by the way, is the hardest thing to do in crypto. And so this is evolving as we speak, but I think capacity and capacity constraint is a gating factor for some institutional investors. And I'll just leave you guys with one stat. So on Liberation Day, April 1st, that week, equities lost about $5 trillion in value during that 1 week. The entire crypto world was about $2.5 trillion in total. So in 1 week, the equity market hiccup was more than the entire market cap here. And so it's super exciting to be in the space because we know that there's so much upside and we know that there's a ton of capacity coming in. And I think that just in terms of market sizing, we're really in early innings here.
But having in terms of capacity, certainly you're absolutely right. The higher frequency of the underlying strategy, the lower is the capacity. Absolutely. So you can adjust your capacity by moving into mid-frequency strategies. And I think the recent move by Tower Research to launch a mid-frequency fund is a reflection of this trend. Yeah. Just to kind of deploy large amount of capital, they would expand sideways or kind of in the mid-frequency.
So there are no more guppies in the bowl, so.
That's correct.
Yeah. And just to the point of discretionary having a role in a quant, alongside a more quant-driven approach, the way we think about it, and going back to the style drift point, is that we have our core quant models that are telling us how invested we should be in our positions day to day. Should we be more invested? Should we be more hedged across a variety of assets? But there's always room for opportunistic overlays to add carry exposure, for example. If we have to be long delta, maybe we'll do it by accumulating GBTC at a discount, for example, as we did a couple of years back. If we have to short, reduce exposure, maybe we'll play into the basis on the future side. So those kinds of opportunities that are carry-driven boost our returns, but they change over time. You're always having to think of new plays that will give you delta plus some carry element, based on market structure developments, based on new instruments that are coming to market. So that's an active effort within our team.
Build a better mousetrap.
And what's the role of machine learning? All the the buzzy words and AI, and I think Martin, what you alluded to sounded a bit like reinforcement learning type of activity. What's the role that this can play in crypto, and how does that compare to traditional finance?
I have many thoughts on this, but I've talked a lot, so if other people want to chime in.
I probably talked the most, so I'm happy too. But, yeah.
So we have a luxury of observing machine learning and AI implementation across multiple PMs in our portfolio. And I have to say that out of top 5 PMs, top 3 of them are heavily using AI in their day-to-day operations. It's not as simplistic as, hey, ChatGPT, create a strategy for me. Certainly not. But for data analytics and kind of reviewing these massive statistical data sets to find patterns, that's where AI can be helpful. And we're seeing this kind of increasingly being used in the portfolio.
Yeah, I mean, I'm sorry. Go ahead.
I was just going to say, we use AI, but in a very specific way. So we like to generate signals with very simple statistics that are transparent to us. And if the market is changing its behavior, we instantly know why that is the case and how it's affecting our models. The way we use AI is to do something called meta-labeling, which is once you have a range of models that you want to run, you can use AI as an overlay to tell you how to adjust your exposure to each model, your weights over time. So it's a safer way to introduce AI in the middle of the market that is really changing its regime and behavior over time. And of course, we use AI to generate reports, follow market developments. This market moves at the speed of light, so I feel that if you don't use AI just for ingesting news and producing research, you are going to be left behind. So that's also a vertical where we're very actively using it today.
Yeah, and we're using it in much the same way, but on a couple of different verticals. So first of all, as I mentioned before, we're taking a lot of our market neutral signal library and converting that into more directional mid-frequency or lower frequency sorts of signals. And in doing that, we're taking the existing library and having AI help us to reinforce and improve it. We're heavily using AI coding assistance. I think that is probably, in my opinion, has been the improvement in these models in the last 3 months even is dramatic. We stood up a risk management model that I used in my previous firm. I recoded it and stood it up it took about 2 months at the previous firm. We did it in 2 days here. And it's helping us manage risk. It's alerting us. You can actually, we're using some workflow engines to then pull in news feeds and parse and generate signals that way. I mean, it is actually, right now, I never thought I would say this, it is indispensable to us.
So I think there's a good way to use AI or machine learning tools in a bad way, and that was a good way. So what I'm about to say is not in. No, I agree with what you're saying. I'm just trying to clarify because I'm going to say some stuff about that I think this is going to be a disaster, and it's not in response to what you just said. That as a coding assistant, it's super helpful. But we run everything with machine learning. Our portfolio managers, if you will, within the fund are essentially architected machine learning ensemble models, and then they have agents that run execution systems, and it's all run that way, trained, etc. So I'm an advocate of machine learning. But what's about to happen is the democratization of the math and science reasoning models like Claude, Grok Super Heavy, O3 Pro, and then some of the unreleased OpenAI models that just got gold in the Math Olympiad. They are about to get released over the next few years, and there's going to be an army of quants. Just like there used to be a few media people, and then there's an army of content creators, and they're not all created equal, there's going to be an army of quants. And they are going to use a lot of like off-the-shelf stuff that was in the public domain from academic papers and practitioner papers that got put into the training data for these things. And they are not going to have built their own models, and they are going to like set these things up with agents, and it's going to be like all the chart technical analysis people who think that they can read a head and shoulders chart and that's going to predict the future, but it's going to be worse because they're going to be run on the same models because they're not going to be able to build them themselves and tune them, and they're not going to have experience as to how to avoid overfitting. And I think this is going to be a disaster for retail, a disaster. So that's my prediction.
And I can predict that alpha decay will intensify going forward.
I think it will be a phenomenal source of alpha to trade against those people. I am so looking forward to it.
All right. Yeah, I mean, there's so many consequences in terms of system fragility and what can happen with those systems. But I think we're running out of time, so we'll end with a few final remarks from each of you. Who wants to start?
I guess we'll go in order. Okay. Look, I think one of the things that we didn't really cover at all is this convergence between, as I mentioned earlier, this convergence between TradFi and crypto, and how large institutions who don't necessarily have or want the complexity of crypto rails are using the equity markets to get crypto exposure, and what that really means for Quant. So I think we're in a really interesting space. Monarq is actually in the middle of a lot of this deal flow right now, and it is super interesting, the actual variability of the quality of the models, if you will, that are being presented to us on an almost daily basis, sometimes 2 or 3 a day. And we've actually had to build an internal quant model to rank these different offerings, and it's actually producing some pretty interesting good results. It actually holds true.
I think we're going to see an aggressive invasion of traditional hedge funds in the crypto space, thanks to changing regulatory environment, which finally will allow multiple players who have been on the side, kind of observing, expressing intellectual curiosity about crypto without being able to engage properly. Now they will. And we're going to see extremely kind of powerful technologies entering this space brought by high-frequency prop shops entering crypto space. So competitive edge will be important. You can either develop this in-house or you can partner potentially with one of these houses. But kind of competition in this space is about to intensify. And margins will be compressed. So we have to be ready for that.
I think the market structure is evolving and institutionalizing. At the same time, I feel that there's still operational credit and technical risk that cannot be overlooked. That hasn't gone away. I think that there will be a blow up at some point, and it's important for investors to not forget that in this new cycle, in this bull market that we're in, to be wary of how they approach engaging with on-chain applications, how they approach trading with certain venues offshore, and how they think about custody and what really custody means in this space. So all that is very easy to forget in this kind of environment, but I think it's a very important point that quant managers need to remember, because it's very easy to start thinking about the maths and the returns, but there's also those blow-up events that happen periodically in our space, and they will become less frequent, but I don't think they've gone away fully yet.
The only thing I'd add is if you're looking at evaluating quant managers, and I think this is true of everyone here, first, obviously you have curiosity as to what they do and is it persistent, do they have an edge and all the rest of it, but I think the first place to start is a fundamental understanding of the risk and return objectives that the fund manager has, and the exploding out those two elements, so skew, intramonth drawdowns, various other kind of questions you should ask, consistency of returns versus upside capture, things like of that nature. Those are the good places to start. What is their objective function? What are they trying to produce for you? I think too many times when we've been talked to by investors who are evaluating folks like us, they just kind of want to try and understand how we do what we do and whether we're good enough to do it. You are never going to understand that. Sorry, you just aren't. What you can do is rigorously understand what we're trying to achieve and whether or not we have done that in the past, and how consistently you think we'll be able to do that in the future, or what the probability of it is. And I think that's the ask that I would have of people looking at quant funds. I don't know if you guys disagree with that, but
Thanks.
Well said.